it is one of those where you have to figure out what matters to you or not. So I like to call it a care plan. You figure out your care plan, and then we can help you execute on it. That's what we're doing with Childfree Legacy. We're going to execute it, but you have to have a plan of what you want your care to look like. If you want to live in your home, you want to do that, great. You can do that if you have the funds to do it. And it has to be part of your plan. Scott, I think the other one is, all right, now I've got a medical issue, so I don't qualify for standalone long-term care. Like, what are my other options? And this is where we got to get a little creative.
There are some options available to you depending on what the issue is. Oftentimes we'll turn to using a product like an annuity that has a long-term care provision or rider on it that will essentially double the amount that you get in the annuity on a monthly basis if you were to need care.
Welcome to the Childfree Wealth Podcast, hosted by Bree and Dr. J, Certified Financial Planner. Here we discuss life and finances as it relates to being child-free. This podcast is for educational and entertainment purposes only. Please consult your advisor before implementing any ideas heard on this podcast.
So this episode coming up is talking about long-term care. And I'm hanging out with Scott from our team, who's an awesome long-term care expert. We're going to talk about a whole bunch of issues. But one of the issues we talk about in this episode is Medicaid. And in full transparency, this was recorded a couple months ago. And now it's coming out in July, right after the passing of this one beautiful bill act, whatever that, OBBBA, that's what he called it. That's not what I'm calling it. So this new act. And the act says, let's cut Medicaid. And they're going to cut Medicaid hard. And the challenge there is Medicaid is run at the state level. So some states are going to be able to backstop this and say like, okay, cool, we'll cover Medicaid, and others won't. So we have a discussion in this episode about Medicaid, but it's still true, but you got to take a little bit with a grain of salt. Prior to the passing of this bill, I would have said, hey, you can count on Medicaid as kind of a safety net. Not a great one, but you can count on it as a safety net. Now I don't know. If you're going to go into long-term care 20 years from now, I don't know what the future is for Medicaid. If you're going to go into long-term care in the next year or two, I'm worried that they're going to run out of money for Medicaid. And I don't know if they're literally going to drop grandpa on the corner. Let's be real. Facilities are not going to keep people there if they're not getting paid. When you listen to this episode, all the stuff on Medicaid and long-term care is still true. But the bottom line is, you probably need to work harder on your own plan than relying on Medicaid after the passage of this act. Hey, Childfree Wealth listeners, we are going to talk about long-term care. And really, we're trying to tackle this question of like, who takes care of you when you can't, and how do you do this? And we have an expert here. Scott Barnes is actually a member of our team, and he is our long-term care guru. But we're going to dive into like, how do you pay for it? And how do you make a plan around it? Really, the question of who's going to take care of when you're older is two parts. One is, what is your financial plan of like, how am I going to pay for it? And the other one is, who makes the decisions for you? We will be launching a new service at the end of the year we call Childfree Legacy. We will be serving in those roles of medical power attorney, financial power attorney, executor, and trustee. So we'll like be there to help make decisions for you. But you still need a financial plan. Does have some type of structure around who's going to pay for it, like what's out of pocket, insurance. You need to figure that out. Now, if you do need someone to serve as your power attorney, executor, all that fun stuff, you can join our wait list at childfreelegacy.com. But that's the other half of the discussion. So we're going to start today with kind of like, how do you make the plan and how do you pay for it and how expensive is it and all of that type of stuff around long-term care. So Scott, where do you start? I mean, it's super overwhelming when a client's like, and what do I do?
Well, the biggest thing is, of course, identifying who potentially, if you have that ability for someone to be able to provide care, because that's most likely the person that's going to end up being the primary source of potential care in the future. So if you have a spouse or a partner, that's somebody that potentially will be there. And then you need to have that conversation. And this is the way I approach it. you need to have the conversation with that person, your financial professional, to say, are they okay providing that care? Are they capable of providing that care? And if they're not, then we need to come up with a specific plan to help address those concerns when you do reach that point where you do need care. And that's one of those things. It starts with that conversation with your significant other or partner or spouse or whatever. And if you don't have that type of person in your life, if you're a single, you're a soloist, then you really just need to have a conversation with your financial professional and have that conversation around, what do I need to do to be able to prepare for potential care when I age? How do I handle that when it comes time? And that's where working with a certified financial planner would be a great place to start in order to sit down and figure out what you need to do to get going.
Yeah, and you're right. It's not one of those you can figure out on your own. I'm just being transparent on that. Yeah, there are certain things you're good taking care of it by yourself. Long-term care, it's a huge investment. It has a lot of choices. It has to do with your financial structure, where you are, like what you want your life to look like. There's a lot of moving parts. And unfortunately, it is a story of have and have-nots. One of the things to keep in mind is Medicare does not pay for long-term care. If you think that's your answer, it's not. Medicaid will, but only after you've run out of most of your assets. You get down to like a couple $1,000s and you're broke. And Medicaid care, it's a crapshoot. It's not always the best care. Often it's bad care. So you have to find that balance. And if you don't have the assets, then you just need to see what you can leverage from either the state, federal organizations, nonprofits, and others to provide support. When you're talking about paying for long-term care, the cost, just so you have the number, it's about $115,000 a year for a single room in a skilled nursing facility. Men will spend 2.2 years in care, women 3.7. So we're talking about hundreds of thousands of dollars. And that cost is going up by 5% each year. And I think the hard part is some people think, oh, well, the government's going to fix this or it's going to improve. And I don't. I mean, what do you think, Scott? And I don't mean to be negative, but
I think, at least in the current political environment, we're seeing that there are potentially going to be a great deal of cuts to Medicaid. So I think that it's best to try not to rely on those services. Medicaid is funded partially by federal and partially by the states. So states do provide some of that, even if the political environment in Washington is not conducive to Medicaid for the future. But it's really something that I would not count on. Either being able to self-fund or utilize insurance policies as a potential way to help pay for long-term care in the future is probably the best way to move forward when you're talking about potentially needing long-term care in the future.
Hey, Childfree Wealth listeners, it's Bree. I highly encourage you to schedule a Childfree Wealth checkup. During this time, you're going to get a couple of forms to fill out that include your life and financial plan. We'll review them, and then we're going to have a meeting and go through them with you. We're going to give you some advice and things to work on and talk through things to make your finances simpler so your life can be amazing. You can schedule yours by going to our website, childfreewealth.com, and clicking the Schedule Now button.
Yeah, and if you're going to self-fund, the rough number I use, and by the way, all of these numbers are really rough. Alaska is double the cost of some other states. It depends on where you're getting your long-term care, but the rough number I use is if you want to self-fund your long-term care today, you just set aside about $500,000. It has to be invested. It has to grow more than 5% each year in order to take care of your long-term care. And then I said that in a conference, and somebody raised their hand is that number for single people or couples? And I said, yes. And they're like, wait a minute, that's not right. And I said, okay, here's the deal. In a couple, as Scott was laying out, sometimes the couple will take care of each other for a period of time. That's kind of expected. So you won't necessarily need to pay for care immediately. If, on the other hand, you're a soloist, you're going to have to pay for care earlier. And it's most expensive for single women, which actually, that's a higher percentage of soloists. And the bottom line is, if you're single, you need to put about $500,000 aside. If you're a couple, it's about $500,000 aside. And not touch it, and it's purely got to be for long-term care. That doesn't include taxes and all the other fun stuff with it. That's a rough number. And Scott, what do you think about that number? Am I in the ballpark?
Yeah, you're definitely in the ballpark. It really just depends on a lot of factors. I mean, like you said, if they're in a place like Alaska or even New York or California, you may end up having much more or more elevated costs just because of what it costs in those particular states. But if you live in, let's say North Carolina, where I am, it's very reasonable. And $500,000 might be a little bit more than you actually need. But it's better to have that in place in case you need it than to not have planned for it all. Because ultimately, if something does happen to you, especially as a soloist, you're going to end up spending down your assets rather quickly when it comes time to actually have to use those funds.
Yep. And so I put my book out, The Childfree Guide to Life Money. And one of the first reviews was like, he's out of touch. He doesn't understand what the world is like. And, the idea that I'd have $500,000 to set aside for long-term care is just crazy. And I'm like, you're right. Like, seriously, it is crazy. But that is the number. Like, I'm not making up the math here. I understand not everybody's going to be able to afford it. Actually, most people can't. And that's where it becomes an issue. If you have less than $500,000 in net worth, you're probably going to end up on Medicaid. I'm just going to call that out. If you have more than $500,000 net worth, then you can either set aside cash or look at long-term care insurance. And kind of the general range I look at is if you have between $500,000 net worth and $3 million net worth, that's usually where it's good to look at long-term care insurance as an option. If you have more than $3 million, you probably could pay out of pocket. If you have less than $500,000, you're probably in Medicaid. Scott, what do you think about that as a kind of general ballpark again?
Yeah, a great ballpark. Under that $500K, you're likely going to be spending down your assets just as part of retirement and everything else before you get to needing potentially long-term care. Not having insurance coverage for that and allowing Medicaid to sort of help pick that up, that's probably your only choice. If you have over those amounts, like you said, up to about $3 million or so, it makes sense to potentially utilize a long-term care insurance policy in order to basically cover that risk for you. You can make an argument for people over that too, to potentially cover that risk if they prefer to transfer that to an insurance company, but they obviously have a little bit more assets to be able to self-fund if they choose to do so.
Yeah, and one of the things I have folks say is, well, I'll use my house for my long-term care insurance. Well, that's a problem. Because if you want to stay in your home, then we get into do I have to do a reverse mortgage to get it out, which could be touchy. I mean, reverse mortgages work, but there's also limits and there's a bunch of issues there. And if you're in a couple and one of you uses the house as a long-term care policy, the other one may be homeless. I don't know. I'm not a big fan of counting on the house. What do you think?
Yeah, I think in some circumstances you can, depending on the situation with reverse mortgages, they can be utilized even in a couple to be able to have both people stay in, even if one uses up most of the reverse mortgage amount. But again, I would not count on that as your sole way to fund a potential long-term care event. Having a plan in place that doesn't include that, I would say that's sort of a last-ditch area to look at, not the area I would start with or plan on from the get-go, because there's other ways that you could do it that would be more efficient.
The problem is there is no this is the easy button for long-term care. There isn't. It's well, this is better than that, and this is where we go. But you need to have a plan. And I tend to try to recommend folks figure out a plan by about their mid-40s. Now, that doesn't mean if you listen to this in your 50s, your 60s, it's too late to plan. No. But mid-40s is where long-term care insurance can be most affordable. And if you're in your 30s, you might be planning a little too early. And if you're in your 70s, you might be planning a little too late. But that kind of mid-40s to 50-ish, that's an optimum place in my mind. Does that make sense?
Yeah, that's definitely the best place to look at those particular options because that's when they're going to be most affordable. They're going to be easiest to get because most likely you don't have any conditions that are going to create a problem with getting long-term care insurance. You may have some family history that might cause some issues, like your parents may end up, if they have a history of Alzheimer's or something like that, that potentially could affect your ability to get insurance. But the 40s and 50s, I think, is an ideal time to be looking at it. You said there's no guarantee that you can't get coverage in your 60s. Most traditional long-term care maxes out at about age 70, 75, so you're probably not going to be able to get anything beyond that. And at that point, especially, every single insurance company is going to be looking at your age, and they're going to be looking at everything to find a reason not to cover you because they don't want to write insurance because it's going to be very expensive. And that's where you're more likely to end up needing care in a short period of time. Whereas if you're buying it in your 40s or 50s, you're likely not to need care for 30 or 40 years. And that's why it's very reasonable to consider that in your earlier years in the 40s and 50s.
Yeah, and for transparency's sake, we do not sell insurance. We do have a webpage I'll send you that's got some quotes on it. We do not make money off of referring folks. We just see it as a good option for some. Having done this a bit, one of the things to think about, when we talk about long-term care insurance, I'll usually try to get a quote for what they call standalone long-term care insurance. It's just long-term care insurance. It's not life insurance. It's not a combination. And when I say that, it provides care in-home, assisted living, or skilled nursing. You can have the variety depending on what you need. But what Scott was alluding to is your price is set by both your health and the health of your parent. And that's where it gets interesting. So general rule is if one of your parents has Alzheimer's dementia, your cost goes up 50% or you may have less coverage. If both of them do have Alzheimer's or dementia, you just can't get coverage. They're going to be like, yep, no, don't bother. There are some ways around it occasionally, but you don't. And then there's some weird stuff. So I had a client the other day who went to apply for it and she's younger, but she's got rheumatoid arthritis. And they're like, yeah, nope, not covering you. And I was like, what do you mean? Help me understand. And the answer was, well, that's a mobility issue. And mobility issues are a big reason why people are in long-term care. I never thought about that. I had somebody else that had Lyme disease, same type of things. There's these kind of weird things that you wouldn't think about in your day-to-day care. And once you're diagnosed with that, you might not be able to get the standard policy. Scott, does that make sense?
Yeah, that does make sense, and it's very true. I mean, there are a lot of certain conditions that will end up causing issues. Even let's say you're on a pain medication, that actually is something for long-term care that they look at because they're like, why are you taking this pain medication? Is it because of mobility? Is it because your joints aren't feeling good? And that's obviously comes into stuff like rheumatoid arthritis. And even it's interesting. I've had many clients that I've worked with over the years that maybe they're getting a knee replacement. Until the knee replacement is completely healed, an insurance company won't even touch you. They basically want you to have usually about 6 months post-surgery to make sure that everything is good before they'll even consider you for a long-term care policy. So it's one of those things, little things you just need to plan on or think about as far as mobility. That's a big thing for long-term care because if you're in any way compromised for mobility purposes, it's going to be very difficult to get it at all.
Yeah, and so this is where people always get a little cranky at insurance. If you actually need insurance, you can't get it. It's just kind of how it works. If you're like, I'm getting ill, I might need long-term care insurance, you're just not going to qualify. And that's because the insurance companies see that as a risk, and they're like, they're not dumb. That's like saying, hey, I want to take a life insurance policy out on me after I get a diagnosis, I'm going to die in 6 months. They're just going to be like, yeah, no. And that's fully within their right to do. Kind of give you some examples. We have a website, and we'll give you an example. We've got some different plans. But when we look at policies, we want to cover about $250 a day of coverage, 3 years of coverage. We're trying to cover those averages and say, we're not going to cover all of your care, but we're going to cover a big chunk of it. And then we put what we call a 3% compound inflation rider. So every year, the amount you get goes up by 3%. I've got some examples. So I want to look at this. A single female. Now, this is with a 4-year benefit period because women, 3.7 years. At age 40, it's somewhere between $4,000 to $5,000 a year. At age 50, it's $5,000 to $6,000. That is expensive, but I don't know. That's could I find that money? Maybe. And if I don't want to be putting aside $500,000, I got to pay that premium for life, but it might be worth it. What do you think about those rates, Scott?
Yeah, that's very true as far as the rates are concerned, of especially for women and single women in particular. It's something that we see quite a bit. And what I would say to that is when you're looking at it, we're recommending a certain amount of coverage, that roughly $250 a day, which is equivalent to $7,500 a month. You may end up needing to get less coverage. And that's not necessarily a bad thing. Having some coverage is probably better than none. Certainly take a look at that as far as a budget is concerned, if that's something that you're concerned about. Because oftentimes, and one of the reasons we don't necessarily recommend trying to cover all costs, so again, the maximum cost if you're doing full nursing home care and just being single and in your own room is probably going to be somewhere around $10,000 to $12,000 a month. We're not saying to get that much coverage because most likely you're going to have some other source of income, whether it be from your retirement funds or Social Security or both, that potentially could help pad that cost. And many organizations or many assisted living or nursing home will end up taking the long-term care coverage and then, of course, whatever income you're getting generated to help pay for those, even if it isn't necessarily in their max amount that they, or the amount that they would want to have covered if they were charging to somebody just straight off the street.
Yeah, and this is where it gets really weird. And if you want to see broken system, look in the U.S. healthcare system. But in long-term care, the way it works is if they take Medicaid, they get paid something like 30 cents on the dollar. And it varies a little state by state, but close enough. They can take the policy from you and, they consider that a self-pay because, technically you pay it and then get reimbursed. And they get 70 cents on the dollar. They're making a whole lot more money than they would through Medicaid. And there's some games because sometimes they may have no quote unquote Medicaid beds, but if you've been there for a couple of years and you've been paying out of pocket, they're like, I'll just keep you and take the Medicaid money. There are a lot of weird games that happen with this, but you have to have money to start to even play the game.
Correct.
What gets interesting is a couple, if I take a 40-year-old woman with 4-year benefit, is $4,000 to $5,000 a year. If I take a couple with 3-year benefit, and then they have what's called a shared pool. So they get 3 years each, and 3 years they can share. So they get the same amount of coverage. For 2 people, it goes up to 6 to 7. So it didn't double for a couple. And part of that is they're giving you a discount because they expect your partner to take care of you, which is what we started with. But the other thing I like to look at is there's one carrier, and sometimes you can find other carriers that offer what they call single pay or 10 pay. And with a single pay, you pay the whole premium up front. So instead of paying per year, you pay the premium up front. And I'll give you an example of this. I had a couple, mid-40s, decent health, no real big problems. And for the coverage, it was $240,000 to pay it up front. So that pays up the whole thing. You have no risk of your payment going up. You don't have no risk of missing a payment. But here's what I want you to compare. They could pay $240,000 up front, have this coverage, or set aside $500,000 and cover it out of pocket. Now we're having a debate.
Yeah, I know which one I would choose. The $240,000.
It's a good debate, but here's what they said to me, which is really interesting. They're like, what if I don't use it? And here's my answer, and I'll get Scott's in a second. But my answer, if you buy long-term care insurance and you don't use it, so about a third of people die in their sleep, they just poof, gone. If that happens to you, you won the game. Yes, you lost on the insurance. You didn't get to claim on it. But if I never have to go in long-term care and I could just live out my years and be healthy and then just poof, die, I actually think that's better, even though financially it may not. I mean, Scott, what do you think? I mean, if I buy it and I don't use it, did I just screw myself over?
No, you definitely didn't. Again, because you're buying it for the reason of having that comfort while you're alive and potentially if you do need it. I mean, you buy your auto insurance, you buy your home insurance to be able to protect those risks, even though they're not likely to happen necessarily. But you want to make sure that if that gives you comfort to know that that is taken care of if something were to happen to you, I say there's absolutely zero problem with it. It's overcoming that objection for folks that decide that, well, that's never going to happen to me. That is usually the bigger concern. They're just more likely to say, well, I'm just going to keep the money and figure it out myself. And there's really not much you can do for those folks other than to say, okay, that's what you do.
And when I say I want you to have a plan for long-term care by your mid-40s, it doesn't have to be buying insurance or setting aside money. If you decide I'm going to gamble on Medicaid, I'm going to make you decide that. And I've even had folks, I'm like, go look at Medicaid care in your area. Now, by the way, when you do that, sometimes people come back and go, I want to make a plan. I jokingly say it, but it's true. I was a medic for years, and you knew Medicaid facilities because your feet stuck to the ground because they're that disgusting. And somebody on one of the comments is like, they're not all that bad. I'm like, you're right. But the chance that you're going to find a good one when you need the care is low.
Yeah, because even those nice communities that do accept Medicaid, they only have a certain number of beds that they allocate to Medicaid because they have to. And chances are they're going to have a waiting list, and it's going to be very difficult to get into. And the ones that you can get into might not be the ones you want to go to.
Yep. And the other one I hear people say is, they want the death with dignity, the opt-out. That's fine, but the legal issues around that are a big one. So there's a bunch of things around that. But the answer I will not take is, we'll figure it out later. You can't. I had somebody mid-50s had a stroke, and, luckily they had a partner to take care of them. But if they didn't have a partner, they would have been in long-term care in their mid-50s. You can't make decisions at that point. You have a cognitive impact from the stroke. If you haven't made a plan, you are at the whims of the state. And I don't mean to be a fear-mongering. That's not what I'm doing. I'm really just trying to be transparent on this is the state of the system. It is not going to improve in our lifetimes. The amount of boomers that are going to long-term care is just going to be astronomical. And how do we pay for it? We have no clue as a society. It's going to get worse before it gets better. So you have to have a plan. And if you choose, I'm not going to put aside money, fine, you're choosing Medicaid. You have to make a conscious choice. Does that make sense?
Yeah, that makes sense. And I would say that for everybody, really, that having a plan is really the key. And we can't do, as financial planners ourselves, we can't do our jobs accurately or correctly without knowing what that plan is. So either you come up with it, or we'll say, okay, you are going to rely on Medicaid. And if you don't have a plan, we have to do something to make sure that we can adjust for that as life continues for you, because we can't do that without knowing what the plan is.
Yeah, and I think it is one of those where you have to figure out what matters to you or not. So I like to call it a care plan. You figure out your care plan, and then we can help you execute on it. That's what we're doing with Childfree Legacy. We're going to execute it, but you have to have a plan of what you want your care to look like. If you want to live in your home, you want to do that, great. You can do that if you have the funds to do it, and it has to be part of your plan. Scott, I think the other one is, all right, now I've got a medical issue, so I don't qualify for standalone long-term care. Like, what are my other options? And this is where we got to get a little creative.
There are some options available to you depending on what the issue is. Oftentimes we'll turn to using a product like an annuity that has a long-term care provision or rider on it that will essentially double the amount that you get in the annuity on a monthly basis if you were to need care.
Yeah, and there are a few of these annuities. There's one annuity we recommend to our clients where you can get coverage for long-term care. The bonus of those is they don't care what your health is. It's just a math equation to them, so there's no medical underwriting. There are some combo life long-term care combos. I'm not as big of a fan of those in that you're buying life insurance that has enough of a value. But Scott also was willing to fight with me on that. So Scott, where are you at?
Yeah, I think it really depends. It's one of those things that we have to run the numbers. I've run some numbers just to see, and usually if you're paying on an annual basis, the traditional long-term care works out. If you're doing that single premium or say 10-pay premium type of scenario, many times the combo products will actually look better from a cost perspective. And it just really depends. And it varies by age. Age 45 to 65, the combo products might look better, but age 65 to 75, the traditional might look better on those limited pay scenarios. It's just one of those things that we take a look at, but you can make an argument for either one. My goal when I'm looking at any of these products is what is the benefit that it's going to pay? If it has a death benefit, fine. I don't care about that. I just want to make sure that the benefit they're receiving for long-term care is going to do what they want it to do.
Yeah, and I'm going to be transparent on this. If you go to an insurance broker and say, hey, I want a long-term care policy, they're going to sell you the life insurance policy.
Yeah.
And part of the reason for that is they make more money on it.
Yeah.
Is that fair, Scott?
Yeah, compared to a traditional long-term care policy, the amount of commissions they receive on those combo products is quite a bit higher. You're almost always going to be pitched something like that. It's not that it's the wrong solution potentially for that client, but that's what they're going to default to. And that's where we can come in and sort of be a guide for you in that regard, because we don't care which product it is, as long as it achieves the goals you want to and is the right product for you, then that's what we're going to recommend. And then we give you to our insurance partner to basically handle that for you.
Hey listeners, like what you're hearing? Don't miss a thing. Sign up for the Childfree Wealth newsletter for weekly tips, tools, and podcast updates. Head to childfreewealth.com/newsletter to get on the list.
Yeah, and if you go to, there's a link in the show notes to our article on long-term care, and there's a link you can get a quote. We use a company called LIS to get quotes, and we've spent a lot of time working with them, and they'll quote you either life insurance or long-term care. We like the long-term care because you're not buying stuff you don't need, but you have to be careful. Some of the other things that happen, like for example, Washington created a long-term care plan for all of their state, but it covers $100 a day for 1 year. So $36,500, and you have to pay 0.58% of your income for at least 10 years to get that. And by the way, people think they're covered, and I'm like, you're covering $36,000 out of $500,000. Like, you might as well not have coverage. And by the way, if you move out of Washington, you lose it. So like, I want to be careful because I've had clients go, oh, I've got long-term care insurance. And I look at it and like, yeah, you technically do, but the amount of coverage you have might cover like 3 months, not 3 years.
Yeah, it's similar to the mandatory minimums that you have for like auto insurance. Like the state or whatever may require you to have this amount, but if something actually happens, you could be really in a bad place as far as your assets being taken if something were to happen and you were liable for an accident. So it's the same thing with the long-term care. You may have the coverage, but it's really not necessarily what is in your best interest as far as what it's actually covering and the amount that it's going to cover for.
Yep. And if I haven't depressed you completely yet, I mean, like, I talk about this all the time and people are like, yeah, it's all broken. And I'm like, it is. That's all I can do is acknowledge it, but you have to have a solution. But if I haven't completely depressed you by now, you can reach out to us. We have a Child Free Wealth checkup, and you can go in and schedule to have us look at your finances and give you a picture. And we've actually added it now, so you can like pick Scott directly and be like, Scott, I want to talk about long-term care, and go into it and figure out what your options are. You know, it's not that like it's all bad. It's just like, which of these options is the best-ish? Like, which of these is the least worse? You know, and which of these works based on your situation. And once you get that, you can sleep better. You know, it's just, you have to start having that, and you got to check the box and then go forward.
If you enjoyed the show, please consider leaving a rating or review. We'd love to keep the conversation going. Please let us know your thoughts wherever comments are available, or email us at media@childfreewealth.com. To stay up to date, find and follow Child Free Wealth on social media. If you're interested in working with us, learn more by visiting our website, childfreewealth.com. We'll see you next time.